So do you know what this graph means? I'll give you a couple of seconds to think about what this graph is all about. 1, 2, 3. So this is the graph of the trend for Google searches when it comes to the pumpkin spice latte, a very, very popular drink at Starbucks. Hey everyone, Couch Investor back to another video for today. So in today's video, I'm going to obviously show you 3 dividend stocks. One of the 3 you probably already know by the intro, it's going to be Starbucks. The other 2, I've probably covered 1 or 2 on the channel already, but I still think they can be of extreme value in your portfolio. Obviously, do share your dividend stocks down in the comments below. And if you want to support me and this channel, do check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to full.com/couchinvestor and make sure to check out all the other links in the pinned comment. So, stock numero uno, and that's AT&T. This stock is very, very popular when it comes to dividend investing. And of course, I'm using StockCart to explain a little bit about the business. You can follow the channel's portfolio on StockCart. Link is down in the description. Free to follow. You can also enter the competition. You might win $250. Link is down as well. And by the way, it's all free. You can click, it's free. Just sign up. So AT&T right now, strong growth potential, acceptable financial status. We're going to talk about that in just a bit. Bearish or oversold when you look at the graph. So last 3 months, it's down 23.4%. The last 5 years, well, hasn't done great returns there, but obviously things have changed for AT&T more recently. Traditional metrics say it is undervalued and it's a strong dividend paying company. Now, right now, the average analyst price target sits 38.84% higher than the price today. So not only do you get dividends, you might also get some growth here as well. Now, when it comes to AT&T, 51% of their revenue is from wireless services. So think of things like 5G still needing to grow, and the adoption of it will grow as well. AT&T is one of the big winners there. Now, with regards to the company's transformation, let's say, so it has made a couple of bad bets in the past, but more recently, they have sold off DirecTV and they've spun off its remaining entertainment assets, and it used that to pay down a chunk of its debt because, well, it had a lot of that. It has also reduced its dividend to free more cash flow, but as you can see right here, it is still paying 6.9% dividend yield. So,
not too bad. Not too bad.
Now, and of course, when we talk about companies like AT&T and when we talk about a recession, high inflation, these are the type of companies that will probably not get affected as big as other companies in the market because, well, we're all using our mobile phone, right? We're all using internet. So it's probably the last thing people will start and cut off. You'll probably start with some luxury things, then maybe streaming, then some extras, and then really as a last resort, maybe AT&T, but let's be honest, it's not going to happen. Stock number 2, and that's a company I've covered in the last dividend video, I believe, and that's Texas Instruments. Now, very common mistake out there, and that's the fact that everybody thinks that Texas Instruments only makes these things, calculators. Best in class, by the way. No, it's not sponsored, but no, they're making calculators, but the big chunk of their revenue and their earnings is coming from analog chips. Not digital, but analog. And their card is looking much better. 102 strengths, 39 weaknesses, strong growth potential, strong financial status, mix of bullish and bearish signals here. Mixed returns history, we can look at the 1 year. Yes, it's down. 3 months, it's up 15%. For the past 5 years, it's up 83.69%. Traditional metrics say it is currently overvalued, and it is a strong dividend-paying company. Now, when it comes to the price targets that analysts has put there, the average one is, well, not that much higher than the current price. Current price, $167.8. Average analyst price target, $179. And when it comes to dividend yield, 2.79%. The company has plenty cash on hand, so don't be afraid of them cutting dividend. They're probably going to increase that. Now, I'm going to read something with regards to Texas Instrument, and I'm going to link the article down in the description and in the pinned comment. Great article from a good friend on Twitter, Stock Metal Investments. So he uses the automotive industry as an example, which is changing rapidly in a few different directions. First, we have the switch from internal combustion engine or ICE vehicles to electric vehicles or EVs. According to ID Tech X, an EV will require around 2.3 times as many semiconductors as an ICE vehicle, as you can see on the picture on the screen. This tailwind gets amplified if we look at the market trends in autonomous vehicles, which are expected to grow from $94 billion in 2021 to $1.8 trillion in 2030, an incredible 38% CAGR. And of course, who's winning in that? Well, Texas Instruments. Texas Instruments is also located in the United States, which is a very big positive in case something happens in Taiwan. Just something good to know. And stock number 3, obviously, is the pumpkin spice latte maker, Starbucks. We've talked about Starbucks in the past. I still think that Starbucks has, well, I won't call it a moat, but there is one certainty in life, well, one of the certainties in life, and that's that people will keep on drinking Starbucks coffee and Starbucks weird drinks, whether it's for Halloween or for Easter or for some other holiday out there, such as maybe the pumpkin spice latte drink, which I don't really understand what the hype is all about, but apparently it's very popular and some people find it the best drink on the planet. If you had it, let me know down in the comments below. But Starbucks, limited growth potential, so that's already not that great, but I do have some information with regards to their latest analyst day, should I say. So management targets 10 to 12% annual growth over the next several years. In the past several years, it was below 10%. So the goal is obviously good. Now let's see if they can execute on that. Continue here on stock cards. So strong financial status, mix of bullish and bearish sentiment when you look at the graph. Mixed returns. So in the last 3 months, it's up 15% as well. Last year, down 18. Last 5 years, it's up 63%. It is currently an overvalued stock, even though right now its PE sits at 20, well, just under 25. I think historically it was closer to 30. So, well, there is that. It's not cheap, but it is cheaper than its historical PE. With regards to the dividends, they say it's here too small or risky dividends because, well, compared to its peers, it might be paying a bit less. But overall, the dividend sits at 2.21%. And they have been increasing that. They have actually announced the increase more recently. So no really issues of them cutting dividend. They actually increase it. Now with regards to Starbucks and more information about, well, the financial status of the company. So increasing profit margins is another significant part of producing 15 to 20% annual earnings per share growth, which obviously is great returns for investors. How will they do that? Well, Starbucks is targeting progressive expansion over the next several years, leaning on technology improvements like automation, supply chain improvements, new store format like pickup stores, which I don't know why they never thought about this before the pandemic, but okay, fine by me right now, and increase drive-thrus. Same thoughts there. I mean, when you saw, I don't know, McDonald's, Burger King, every fast food chain do drive-thrus, why didn't Starbucks start and do the same thing? I mean, you need a quick coffee and a quick donut or something like that. Drive-thru, Starbucks, that's about it. Instead of just waiting in line, getting your coffee, maybe sitting, maybe not sitting. I mean, of course, we all enjoy to use their free Wi-Fi, but from a business standpoint, pickups, drive-thru, no-brainer.
Well, you got me. By all accounts, it doesn't make sense.
So, overall, these are the 3 dividend stocks. They're not just paying dividends, but they're also growing. So that's a great combination, especially, well, I have in my personal portfolio, I just have one dividend paying stock, which is Intel, which I also expect it to be a growing stock in the coming years. Obviously, many of us have different thoughts about Intel right now, but do share your thoughts on dividend stocks down in the comments below. If you have any of the three today, let me know down in the comments below. And if you enjoy this type of videos, leave it a thumbs up. If you haven't subscribed to this channel, maybe that subscribe button, and I see you all in the next one.